What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
Michael, another exciting week in markets. And this past week, you hosted a webinar for clients on the kind of paradigm shift we've seen between interest rates and stocks. And that was building upon something you did 2 years ago, which has turned out to be an enormous theme for markets. Want to give us a little bit on what this paradigm shift is about and what you were talking about?
Sure, yeah, I can go back to October 2nd, 2023. That was when the light bulb went off. I remember I was in Boston seeing clients with Mr. Jay Glickson, salesperson at Piper. And the market had been selling off in August and September, mostly on the back of higher interest rates, which ended up being the high in interest rates. 10-year got to 5%, mortgage rates got to 8%. And in early October, we kind of threw out a lot of the ideas we had been talking about for the economy and just said, the market outlook is very simple in the near term. Anything that can bring rates down is going to be bullish for equities. And if rates continue to move higher, markets will continue to move lower. And then 2.5 weeks later, you saw one of the biggest rallies probably in market history beginning in late October, and a huge rally in bonds as well. And I remember that those last 2 months, you had everything possibly that could have come out dovish came out dovish. Yellen issued short-term T-bills, so the market liked that. We had good inflation data. We had soft employment data. And so for all of the reasons you could possibly think of, bond yields began to rally, and pretty much that kicked off a massive rally in the equity market. I remember a stat from back then. The Russell 2000 went from a 52-week low to a 52-week high in something like 3 or 4 weeks, which was the fastest in history. And it was all due to interest rates coming down at a time where there was a tremendous amount of inflation anxiety. And so light bulb went off in our heads that this is, one, the correlations are probably likely to remain negative with respect to interest rates and equities. And the shock of the 2022 inflation spike would likely last with us for a very long time. And I remember beginning to make the argument back in October of 2023 that we needed to see higher unemployment to get the stock market to move higher, which a lot of people looked at me in a very curious, perplexive way. I probably got to call a few names during that time too. And the point there was that, again, anything that brought down interest rates would be bullish. And one of the, I think, clear ways that we were able to get interest rates down was the unemployment rate did start moving up later in 2023, and it did so for the next 2 years, modestly, but that marked the high in mortgage rates. It marked the high in the 10-year, and pretty much between late 2023 and really all the way through today, every time we've seen rates rally for really any reason, the market has broadened out and gone up pretty significantly. And so we did a webinar a few months later in February of 2024, after doing a lot of work and research on the markets and behavior back in the 60s, 70s, 80s, all the way to the late 90s, where you had a 30-year period that was somewhat similar to what we were currently experiencing, which was that interest rates and equities were persistently negatively correlated. And that doesn't mean that every day rates went up, stocks went down, and vice versa. Correlations were around anywhere between negative 50 to negative 30%. So some days and weeks it mattered more and there was a stronger correlation. Other periods, the correlation kind of weakened a bit, but generally remained negative. And so we put a webinar out in February after doing a ton of work and made the argument that we've entered a new paradigm shift in behavior of investors and probably policymakers and consumers and companies, that the risk to the market, as far as we can see ahead, was likely to be anything that pushed up interest rates sustainably, rather than what typically was a risk for the market, which was a growth scare. And when you're in a world where interest rates and equities are moving in opposite directions, that tells you the market is more fearful of higher inflation and interest rates and not so focused on growth. Or in a real simple way, it creates the backdrop where you can often see bad news is good for equities.
So that's pretty incredible. This is a backdrop that most investors have unlikely seen in their career. You're talking about multiple decades ago was the last time you saw this kind of negative correlation between equities and interest rates.
Yeah, I'm certainly a victim of that historical period because in my career, and I know most of your career too, we only saw stocks that went down due to growth concerns. And just about every time rates were falling too, providing no immediate relief. And so it's really the reason why in 2022, in our outlook for 23, we remained bearish for too long and were wrong because we were fearful that unemployment was going to rise and earnings would slow and growth would slow. And if anything, that actually helped the market and took us a couple quarters, certainly, to realize that something had dramatically shifted from anything I'd seen in my career. And obviously doing all that work in the fourth quarter of 2023 gave us what we felt is a pretty good handle for this regime shift and how typical market behavior, higher unemployment rates are bearish, weren't necessarily true anymore.
We're talking about themes that take a long time to play out and change. Do you see this continuing to last into the future?
Possibly. I certainly don't think it's going to be ending anytime soon, i.e. 2026, 2027. Beyond there, it's a little harder to call, but I can tell you that the layman's way to think about what could end this is when we stop hearing about affordability and when you stop seeing consumer confidence hit record low levels due to basically just a bunch of consumers really pissed off that the price of gas and food and everything else costs a lot more, which even I would say that consumer sentiment data, which is a reflection of this inflation anxiety, is really now just reflecting that rather than the ability for consumers to spend. Obviously, we have a very bifurcated consumer today, and the price hikes in oil and gasoline and other things and interest rates are certainly pounding on the lower end consumer. But the reality is that due to the bifurcation in income and wealth and demographics, that part of the consumer just doesn't drive the economy as much as it used to when things were kind of more even keeled. So it creates a lot of separation and it creates a backdrop where it's really easy to find bearish data and hearing companies on earnings calls talking about trade down and weak consumers from the low income folks. However, that doesn't always necessarily mean that it represents the aggregate, especially during a time of this massive AI CapEx cycle that's obviously leading to a booming backdrop for earnings.
It's definitely going to take some time before I become accustomed to the new price levels and I stop complaining about the price of eggs and other items.
Yeah, my 12-year-old daughter went to the theater last night to go see Devil Wears Prada 2 and given her some money on her Apple card. And I asked her this morning how much she spent. She said I bought a ticket, was something like $16. And then I bought a popcorn and a soda. That was $25. And I'm thinking, cumulatively, that was $25, but no, for popcorn and soda, it was $25. And then I looked at her, made a joke. I'm like, damn, that's expensive. And she looked at me and said, Dad, inflation, because even she gets it. And maybe not the best example because we all know popcorn and soda are egregiously expensive at the theater, but it's a good point though. I think we're all going to be, regardless of income levels, just recognizing, especially you and I are in our 40s, remembering this used to cost X and Y, and that used to cost this. It makes me feel old. It used to be a nickel to go to a Yankee game, right? Great grandparents would say that. So yeah, it's going to take a long time. And just as an interesting stat, the last time we had a broad-based problem with affordability in the United States was, or the last time it ended, or the last time it peaked would be the early 1980s. And during that time, you also had a period where the market and interest rates were very deeply negatively correlated. In fact, that was one of the deepest points in history. And it took 18 years before you saw market correlations flip back to positive correlations with interest rates and equities. In other words, the markets were no longer fearful of rates going up and down. You had enough time go by where you had a new generation of people and investors and leaders, and real incomes certainly went up quite a bit. And inflation obviously came down a lot through the 80s and 90s. So it took 18 years from the peak of CPI. We're right now only almost not even 4 years past the peak in CPI. And so we've certainly not gotten down to very low levels, or certainly seen much disinflation or deflation anywhere. So yeah, I would venture to say that this is going to be an issue we're definitely going to be talking about still in 5 years and probably longer.
So you've touched on a little bit some of the things that could end this change in this relationship we've seen. Can you elaborate on a little more? What are the signposts that we had before?
If we go back to the example of 1998, where it was the last time we had a massive sustainable regime shift where interest rates and equities pretty much persistently moved in the same direction, what you had seen leading up to that was that inflation had gotten down to around 2% and it stayed there for a long time. During that year of 98, oil fell down to $10, and we were on our way there maybe in terms of the price of oil. We got down to the low 50s about 5-6 months ago. But again, this is not just an oil problem. This is a broader price issue. I don't think there's any one specific thing. I think certainly it's many years of real income growth and starting to heal this K-shaped economy. And obviously that can come in many forms. I wouldn't be surprised down the road, if we have a different administration, we see much higher taxes on the upper income folks to redistribute that down to the lower income folks, as well as a lot of political rhetoric about trying to help that low-end consumer. Look at what's going on in New York with Mandami, right? He got elected for this exact issue and certainly helped President Trump get elected also a couple of years ago. So there's no magic wand or magic solution, but something that would cause many years of disinflation and real income growth is what is needed. So we're stuck with this backdrop, I think, where anytime rates go up for 2 to 3 months and investors start pricing in a rate hike where markets are going to see its breath decline. We've seen retail stocks get pummeled in March and April. And they've certainly done well in the last week because rates are down 20 basis points from about 2 weeks ago now. And those stocks have done really well. So a lot of people tend to take what I'm saying and say, look, the market's doing fine while interest rates are up. And that's generally true. It hasn't necessarily been true when the 10 years above 4.5 and rising. But it's really under the surface. Outside of AI, a lot of those stocks are very rate sensitive, and that's where you see all the volatility. So it matters for most investors because it really helps them determine how they want to be positioned. Do I want to just completely continue to avoid consumer stocks? And even there, to me, it's more about where rates are going, less about where the consumer is going. I think the consumer, again, in aggregate is fine. The job market's fine. There's a big split between high and low income. And that's probably not going to change materially in the next year or two. But what is clearly driving stocks like the XRT, the XHB, that's retail and housing, is really the swings are coming from the multiples, which are being driven by changes in interest rates.
Such an important topic. And let's not wait 2 years before you give us another update.
Yeah, it's certainly become more popular now. If you scroll on Twitter, I always play around scrolling through Twitter, trying to come up with ideas through a mosaic process. And I have seen many people post the chart of correlations of equities and bonds. And I think at a 30-day correlation, the interest rates and equities are at extremely negative levels today that we haven't seen in a couple decades. So it's getting a lot of attention now. But again, I see all these charts of people saying, look, bonds and equities are trading with this correlation. But I don't think people fully understand why, and also for how long this is going to last. And I feel fortunate that you and I and the team have done a lot of work on this going back to 2023 and have, I think, hopefully helped clients navigate this and understand the drivers of when this could become a more broad problem for equities and when it's only a problem for subsets of equities. But I believe that we're going to see rates lower. I've been saying this now for 2 weeks. It looked pretty dumb for a couple days when we hit 468 on the 10-year, but now at 445, 444 on Friday. We'll see. But what could keep pushing rates down, of course, if oil prices fell and we keep inching closer to a potential deal. If we get any softness in jobs data, that's, again, a really easy way to get rates down. Or if we see some weaker economic activity data. And again, the conclusion here is that softer growth, especially right now where the market's playing with pricing in a rate hike later this year, may actually be just what the market needs to broaden out and go up, because that could bring us lower interest rates and relieve that inflation anxiety that markets are clearly dealing with right now.
Thanks so much for your time, Michael.
All right, Steve. Maybe next time I will talk about the other big important part of the market, which is AI. I could view the two major themes for equities right now and the outlook as AI and IA, obviously artificial intelligence, and IA, which is inflation anxiety. So next week, perhaps we'll dive into AI because there's certainly plenty to talk about there.
So true.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.